Hello traders, Gary Wagner here. Approximately 1:30 in Honolulu, 6:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 7th day of January 2022, and this is the daily report for gold and silver, our weekend review, and an interesting week in that we have already put 2 trades on. We've exited 1 trade with a small profit. We'll talk about our trades in detail, but today's news was a tepid jobs report. The forecast was 400,000 jobs would have been added to payrolls in December. The actual numbers were just shy of 200,000. It seems as though the economists being polled have had consistent misses, overestimating the amount of new jobs. We still have a high level of inflation, and with the upcoming FOMC meeting at the end of this month, the Federal Reserve has a very, very difficult task at balancing all of the forces at play. Clearly, the recent surge in the new COVID-19 variant, Omicron, has stifled the creation of new jobs. The jobs report revealed today that only 200,000 new jobs were added to payrolls last month. The forecast was 400,000. That was highly supportive of gold, and it also indicates that the current inflationary pressure will continue to at least stay stable or rise. February futures gained $7.30 and is currently fixed at $1,796.50. We did go long just the other day. We'll talk about that trade along with an earlier trade we did this week when we pull up our technical study. Silver also had nice gains today, gaining 19.5 cents, with the March contract up 0.88% at $22.38.5. We did have some dollar weakness that accounted for some tailwinds. The dollar itself sunk by 0.6% and is currently fixed at 95.74. Unquestionably, gold continues to trade in a range-bound manner. There are no real defined trends. However, we did put 2 trades on this week. The first trade that we put on occurred on the 3rd day of January. That was right here. We went long at 1801. On the following day, we raised our stop to 1810 under the assumption that increased volatility was highly likely as they were about to release the minutes from the December FOMC meeting. The market did trade as high as 1830, but it did come down and take us out with a small profit, $700 per contract. Yesterday, we re-entered the market, buying the dip and entering at $1,787.60. We placed our stop at $1,772. We remain long, and our stop is still at $1,772. Our recommendation is to maintain your current long position and to maintain your current stop. We are currently very close to reaching 1,800, and our next band of resistance itself comes in between 1,805 and 1,800. That is this green bar that I'm drawing in there. The small line here represents 1,800. 1804.60 is the 61.8% Fibonacci retracement. It also corresponds to the 50-day moving average. I would be comfortable seeing us take that out early in the week, and our next level would come in approximately $1,815. Under the assumption that gold continues to rise next week, we will look to move our stop. As you can see, currently our stop is placed at 1772. The first area we would look to move it to would be the 78% fib retracement. That comes in at 1784, and beyond that is 1793, which is the 100-day moving average. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.